If buy, borrow, die were a machine, buy is the engine, not the pedals, not the steering wheel, the engine. If you get this part wrong, nothing downstream works. No borrowing, no tax efficiency, no clean exit. So today, we slow down and get very clear on what buy actually means. This episode is not about what to buy next. No stock tips, no hot assets, no "this is going to explode" nonsense. This is about definition. Because most people think they're buying assets when they're really just owning expensive stuff. And those are not the same thing. The buy step means using capital to purchase assets that have the potential to increase in value over time. Not consume cash, not sit idle, and not quietly decay. An appreciating asset is something expected, over long periods, to be worth more in the future than it is today. And here's the critical part. Under current U.S. tax law, you are not taxed on that growth while you hold the asset. The gain is unrealized. No sale, no tax. Your net worth can rise for years, sometimes decades, without triggering a taxable event. That's not a loophole. That's just how the system works. So what usually qualifies? Publicly traded stocks. Ownership in companies expected to grow earnings and value over time. Real estate. Property that increases in value due to location, demand, inflation, or improvements. Alternative or collectible assets. Art, wine, classic cars. Things with long histories of appreciation, scarcity, and demand. Different assets, different risks, but the same job. To hold value and ideally grow it without requiring constant selling. Here's the insight most people miss. Buy is not about returns. Buy is about durability. Because buy, borrow, die doesn't need assets that spike. It needs assets that survive. Assets that can sit through volatility, hold collateral value, be borrowed against without panic. If an asset can't survive a bad year, it can't support the rest of the blueprint. Buy is not trading. Buy is not chasing. Buy is not, "this thing moved fast, so I want it." Buy is your engine choice. Because everything in this blueprint runs on what you install here. Think about engines. There's the high-performance Formula One engine. Incredible power, extreme precision, built to win races. But it has a problem. It's fragile. After every race, it gets torn down, inspected, rebuilt. Miss one detail, and it fails catastrophically. That engine is amazing, as long as you're a full-time team with mechanics, telemetry, and zero margin for error. That's how a lot of people build their investments. Then there's the durable engine. Still powerful, still capable, but designed for longevity. If you maintain it properly, change the oil, respect the limits, don't abuse it, it starts every day, runs through bad conditions, carries you long distances without drama. It doesn't need to be rebuilt constantly to keep working. Most people choose Formula One money. They want speed. They want performance. They want something impressive. But they don't realize they're signing up for constant rebuilds. One bad market, one wrong move, one missed moment, and the engine blows. Then they say, "Investing is risky." No, their engine was. So here's the real question. Is the thing you're buying an engine designed to win short races, or an engine designed to run for decades? Does it require perfect timing, constant monitoring, and rebuilds just to survive? Or can it keep running while you live your life? Because buy, borrow, die doesn't work with engines that need to be torn apart every time conditions change. This is why buy comes first. Because only a durable engine can later support borrowing without stress, Only an engine built for longevity can compound quietly without constant intervention. You don't borrow against something fragile. You borrow against something that keeps running. Buy installs the engine. Everything else, borrow, tax efficiency, continuity, depends on what you put under the hood. Most people ask, what should I buy? The better question is, what can I own and still sleep at night for the next 10 years? High performance is impressive. Durability is what gets you there. Choose the engine accordingly. In the next episode, we'll move to borrow, how liquidity actually works, why selling is usually the expensive move, and how strong assets let you access money without tearing the system down. If this helped sharpen how you think about buying, like it, follow along, and I'll see you in the next one. I'm Frank.